What is going on, guys? So this has been something that's been really on my mind lately, and I know a lot of people, especially those people newer to the stock market, don't fully understand this. Even a lot of people who have been in the market for a few years might not even fully get this, or even maybe hearing me explain it might be able to help a lot of you guys get refocused and just bring you back to square one in a market that's constantly full of distractions. Quickly, if you do want some commission-free trades on Questrade or some free stocks on Wealthsimple, two platforms that I both personally use and stand by, links to sign up will be in the description or pinned comment. So this is without doubt the most single important concept when it comes to the stock market. This is the most important thing to wrap your head around. Knowing this simple concept, not just knowing it, but understanding it fully, should give you a clear understanding about how the stock market itself works and how you can navigate through any uncertainty in the future and really simplify things for you. And when distractions are floating around, you can fall back on this framework and really avoid getting lost in them. Because once you know this concept and fully understand it, literally everything will make sense to you. And I guarantee you that just understanding this could possibly make millions of dollars worth of difference by the time you retire. So let's get into it. The single most important thing you want to wrap your head around is to know what you're actually buying when you buy a stock. Yes, you're buying a share of ownership of a publicly traded business. We all know that. But what are you really actually buying? You're buying into a share of a stream of cash flow that's generated by that business. That's essentially what a stock represents. The stock of a company represents the present value of all future cash flows generated by that business. Now, it's important to note that that's what a stock is supposed to represent, but I'll come back to this in just a bit because there's another really important thing that you need to understand. First, let me paint an example, a really, really simple one. So I've got a lemonade stand, and I make a profit of $10 a day from it, and you buy one share of the 10 shares at my lemonade stand. So your one share represents 10% of that daily stream of income of $10 a day. So your share is essentially worth $1 a day for as long as I stay in business with my lemonade stand. Understanding that you're buying a share of a stream of cash flows that a business generates should literally make everything make sense from a standpoint of realizing if you're getting a good deal on a stock or not. To fully explain it, let me really, again, dumb down things for a lot of people here. So if I told you that my lemonade stand makes $10 a day, and the lemonade stand across the street also makes $10 a day, which lemonade stand are you going to pay more money to own a share of, assuming that everything else is the same? You wouldn't pay any more for mine than you would for the one across the street, right? That's because they're both still going to give you that same $1 a day regardless of what you pay. Now, if my lemonade stand made $12 a day and that other lemonade stand made $10 a day, you'd obviously pay more for a share of my stand, right? Exactly. Now, where it gets a lot more complicated is where you throw in things like growth and rumors in here, like with every stock in the stock market. But let me illustrate those. So let me talk about growth here. So if there's two companies available for you to buy, and this is the stream of income generated by both companies. So one company is giving you $1 a year for the next 5 years. And the second company is giving you a stream of income that's growing by $1 a year over the next 5 years. Which one of these two companies are you going to pay more money for? Obviously the second stream, because it's growing. Because the money you're receiving from that business is going to be much higher in the future than it is for the first company. But what messes a lot of people up is when you ask them how much more they're willing to pay for that second company. Because it is actually possible to overpay for growth. And that's actually what most people do in the stock market. And it's why most people are going to lose money in the stock market over long periods of time. Like, yes, you obviously want to pay more for that second stream of income. But what if I told you that that second stream of income will cost you 50 times more than that first stream of income? Then you probably tell me that sounds like a bit of a ripoff, right? By buying that second company, you'd receive $15 in 5 years, which is $10 more than the $5 you'd receive from the first company after 5 years. But if that second company cost you more than 50 times more to buy, you simply got ripped off. You got a bad deal. Because you're paying 50 times for double the income in 5 years. Now, you can throw other factors in here as well to change things. For example, say these were two companies and these are their streams of income that you had to choose between. The first is the same as the first company from the previous example, so it's $1 a year for 5 years. Now, the second company, Company B, won't give you any money for the next 4 years, but in 5 years, it's going to give you $5. Which one would you pay more for? The average person might say neither, because after 5 years, you're still going to receive $5 regardless of which company you're buying. And this is actually completely wrong. Because if you own that first company, you could actually invest every $1 a year you make for the next 4 years. And then the compounded growth of investing that $1 a year would make your total money worth more than $5 in 5 years. So with this mentality, which option seems like a better deal? If I told you now that you could buy both these companies for the exact same amount of money, knowing now what you know, you'd obviously choose the first company, right? Because you're getting a better deal. And the crazy thing is that most people in the stock market will actually buy the second company because the thought of that future growth seems much more attractive, because that 5 in year 5 looks a lot better than the 1 in year 5, even though you know now that you're actually getting more for your money out of that first company. And so what if I had both these companies and I wanted to sell them to you for both these streams of income, but instead I wanted 6 times more money for that second company? And on top of that, I told you that there's also a chance that that second company might go bankrupt as well. I mean, you'd think I'm crazy, right? It's actually hilarious though, because that's literally exactly what's happening in the stock market right now. The first stream of income represents Molson Coors stock. Molson Coors has brought in over $1 billion of free cash flow over the past 5 years. The second stream of income represents Lucid Motors stock. Lucid hasn't even sold the car yet. They actually lost $600 million this year and are likely going to keep losing money over the next couple years before they eventually become profitable. And they're trading at a $60 billion market cap. Molson Coors, on the other hand, is trading at a $10 billion market cap. So you're paying more than 6 times more for that second stream of cash flows that also has a chance of going bankrupt. Now, you're going to look at me and go, JP, bro, Lucid Motors is the future. They're the next Tesla. Literally none of that changes the fact that you're still paying 6 times more for that second stream of income in this example here. And did we not agree upon earlier that that first stream of income is more valuable because of that compounding power of the money you're going to receive? Yes, it is possible that everything works out for Lucid and they end up making much more than $1 billion a year in free cash flow. The question is, though, how likely is it and how long is it from now? You know how many car companies have completely disappeared or gone bankrupt and had to be bailed out over the past 100 years? You've got to ask yourself, is 6 times more for the second stream of income really worth it? It sounds to me like you're overpaying for growth here. At the end of the day, understand what you're buying. You're buying into a share of a stream of cash flow, and a dollar is a dollar, regardless of where it comes from. It doesn't matter to you whether that first stream of income comes from selling potatoes, and the second is some, high-tech, futuristic robot transformers. Sure, the second one sounds a lot more interesting, and everybody on the internet is telling you that it's the future and it's going to the moon. But if all you're really getting from these is a stream of cash flow, does it really matter where that cash is coming from or how exciting it is? Now, there is actually a way to determine whether or not you're paying a fair price for growth. Most of the time, to be honest, in this market in 2021, the honest truth is you're probably not. But there are some fairly priced growth stocks, or even undervalued ones for that matter. But how do you know if you're paying too much for growth or not? Because say this is what the 2 streams of income look like. How do you know which one you should pay more for? This is where discounted cash flow models come into play. You essentially want to use some math to determine which one of these stocks is worth more in today's money to justify which one you should pay more for. Because remember the fact that if you can invest that money that you get in earlier years and receive, an 8% return on that money, it's worth more than the money you'll receive in later years by that compounded factor of that 8%. So you can find discounted cash flow models online to use for free, or you can even build them in Excel yourself if you learn how. This isn't going to be a video on how to do a discounted cash flow model, but if you're really serious about picking your own stocks, it is a tool that I highly recommend you consider either learning how to build or finding one and just learning about it eventually. So quickly an example of how the idea works though. So these are 2 streams of cash flows. Company A is growing cash flows extremely slow, while Company B has no cash flows right now, but it's going to have massive growth in the future. And by the end of year 5, it'll be doing 2 times the cash flow that Company A is doing. How do you know which one of these 2 companies is more valuable today? You've got to be thinking it's that second one because that growth is so explosive and it's going to be giving you 2 times the cash in 5 years. Well, doing an NPV calculation, net present value, using a rate of return of 8%, Company A is still worth more today over the next 5 years. Now, obviously, this is really simplified, and if this growth continues into the future at the same rate, Company B is going to be worth a lot more. But I'm giving you a simplified example just to show you how this works. Money today is worth a lot more than money in the future. Look at this example. Company A's cash flows are actually declining over the next 5 years, while Company B is growing cash flows every single year. Which one would you buy? The company whose cash flow is declining, or the one that's growing cash flows double digits and is going to give you more than 2 times the cash in 5 years? Company B sounds a lot more exciting, it sounds a lot more interesting, but Company A is still worth more today when you find the net present values of both. So if you could buy Company A for less than you could Company B because everyone wants to overpay for that growth, you're getting a hell of a deal. You're getting something that's worth more for less. Now, I'm not saying that growth isn't important. 9 times out of 10, you do want to pay more for that stream of cash that's growing. But I'm showing you that not only is a declining stream of cash still worth something, in some cases, it actually can be worth more than one that's still growing. So now, like I said earlier, this stream of future cash flows is what the stock of a company is supposed to represent. But because it's traded on a public market, you've got other factors at play, such as supply and demand, that are going to impact that stock price. And that's exactly what leads to a stock being undervalued or overvalued. When the market value, caused by supply and demand, exceeds or is less than the intrinsic value of the stock itself, which again is basically that present value of all the future cash flows. So as investors, these differences are what we're looking for. We treat them as opportunities. Whenever it comes to investing in stocks, there's one incredibly important concept for you to understand. Like I said earlier, this should be a moment of clarity where everything starts to really click and make sense to you, and you're able to judge a good stock from a bad one. And it's this. The price of a stock over long periods of time always equals the fundamental value of the business. But at any given moment in time, it rarely ever equals the fundamental value. So stock price over long periods of time equals fundamentals. But stock price at any given moment in time never equals fundamentals. Well, almost never. Seems kind of trippy at first, I get it, but this picture I show you here will paint things clearly for you. So the red line represents the fundamental or intrinsic value of a business over time, what the stock price should represent, and that's the present value of those future cash flows. Now the black line here, fluctuating, is the stock price. So over time, it's going to follow that fundamental value, but there's going to be moments throughout that time, like these, where the stock gets hyped up, and everyone's talking about it, and you're seeing, YouTube videos with thumbnails saying the next 10x stock, and it's going to lead to that stock price exceeding the intrinsic value. These are the points where you want to avoid buying to maximize your return if you're in it for the long run. Then, something's going to happen. Times are going to change and people are going to call the company dead, like Microsoft back in 2012. And the stock price is going to be way down here, well below its intrinsic value. Now look at Microsoft stock. It's way back up here again. But see how over long periods of time, that stock price is generally going to average out and equal that fundamental intrinsic value. But at any given moment, it never quite equals it. Our goal as investors is to buy that stock when it's trading below its fundamental value. These are also the times when everyone really hates the stock or they're scared of investing in general. But you have to really condition yourself to love the stock at these points and hate it at these, which is really hard to do because at these moments, everyone's telling you it's the greatest investment in the world. You have to buy it. It's going to the moon. Because what's going to give you a better return over time? Buying the stock when all the YouTubers and, Motley Fool articles are saying buy, which are these times up here? Or buying when everyone hates the stock, which is down here. If you buy it down here, you're going to end up with a ton more shares over the long run because you bought more when you could afford it than when it was trading up here. Learn to love the stock when people are telling you that the company's dead, or that they're not with the times. And avoid that stock and run for the hills when, you hear your buddy's brother, who may be retarded, and just downloaded Wealthsimple yesterday and saying he bought that stock. Peak hype, peak media typically results with these peak stock prices. Because everyone wants to buy that stock then, and the demand is going to make it exceed its intrinsic value. Understand fundamentals and avoid hype, and it will literally make you millions of dollars of difference over 30, 40 years from now. Because the real sad truth is, you can say that, if I bought it at all these peaks, I'd still be up over the long run. The truth is that most people buy the stock up here, and they don't understand why they bought it. They just bought it because a thumbnail said it's 10xing. So when it starts crashing down here, they stop seeing those 10x thumbnails on YouTube, and they don't really understand why they bought it in the first place. They don't understand the fundamental intrinsic value, which represents this, and know that, that stock's eventually going to rebound up and follow that intrinsic value. And they're going to sell it down here. So they don't even make it to the end all the way up here. Those people go broke or stop investing. If you buy here and stick to the process and understand what you're doing, you're going to be significantly richer than all those people at the end of the road. Because sometimes it won't even look like this. It'll look like this. And all those people are going to buy it way up here and sell way down here. But over time, that stock price will always revert back to those fundamentals. GameStop will too eventually, guys. I promise you that. One day, GameStop will be worthless. Unless, they can eventually turn that business model around by, taking advantage of all the stupid shareholders, issuing shares and stuff. No offense if you guys are hodling that. Hey, I'm just saying. This cycle always plays out, and when you're aware of it, you can use it to your advantage. It just takes patience and discipline, which honestly, very tough to develop. You buy down here, you're saying one Lambo, and, you sell before it even hits here because you lose your patience. These swings can honestly take, a year or even a couple to fully manifest. You might get lucky and they might take a couple quarters, but they also might take a couple years. It's always different. Just whenever you're questioning what you're doing and why your stocks haven't hit Pluto yet, just remember this exact image, this exact chart. You're here right now. And if your fundamental analysis was correct, because you understand what you're paying for and a stream of cash flows, and you didn't overpay for it, you'll be here soon enough. So you can sell when you believe your stock is overvalued and when you think it's up here, or you can take the Buffett approach and just hold it. Just know that it'll eventually reach a point again in time where that stock starts to go down here again. As long as you have the discipline not to panic and sell, and you held it through those highs, and you continue to hold it through those lows, and to even buy more if you feel it hits another low, according to your updated fundamental analysis, you'll be okay. But that's honestly the toughest part. For me personally, keeping this image in my mind makes the world of difference. And it's allowed me to confidently buy stocks like Molson Coors, Discovery, Alibaba, when they're all down here and keep going down and down. And just to keep on buying them as, they stay down here for extended periods of time or even keep following. Just remember this. Remember this image. And I hope this helps one or two of you guys at least. But with that being said, that's been my time, and I thank each and every one of you guys and gals for yours. I hope some of you guys did enjoy this video. These ones honestly don't get the most views, but it makes me feel a lot better about myself putting out these videos. I just feel like I'm actually doing people a service and making a positive difference for one or two of you guys. When I started this channel and I barely had any views or subs, I always felt pressure to cater to what people wanted to watch, rather than what was actually truly beneficial content and what people needed to hear. YouTube has a weird way of punishing you for giving good advice and rewarding completely toxic advice. I'm just at a point right now where I don't really care about the algorithm anymore. I'd just rather build an authentic brand and channel that's going to be sustainable and stand the test of time, unlike a lot of these other hype YouTubers. I just took 3 months off for God's sakes. If I ever cared about that algorithm, Lord knows I've already lost it. Sorry for the rant though. I do hope you guys appreciated this one, and until next time, peace.